The United States economy currently presents a picture of cautious observation. Market participants are keenly focused on the Federal Reserve's next moves. It is widely anticipated that the central bank will maintain its current interest rate stance in the near term. This prudent approach stems from persistent uncertainties clouding the economic horizon. Future policy adjustments by the Federal Reserve will be heavily reliant on incoming economic data and evolving conditions. The Fed itself has acknowledged rising uncertainty. There is also a tangible risk of stagflation, a difficult combination of sluggish economic growth and persistently high inflation. This complex scenario makes the Federal Reserve's task of balancing stability and growth exceptionally challenging for policymakers in the current climate. Recent data has added layers to this economic complexity. For instance, ADP reported that U.S. private payrolls saw a smaller increase than anticipated in May 2025, with only 37,000 jobs added. This figure was a significant drop from the revised 60,000 jobs in April, and fell well short of the forecasted 110,000 new positions. In the political sphere, President Donald Trump publicly urged Federal Reserve Chair Jerome Powell to lower interest rates, citing this slowdown in job creation. Following this, President Trump and Chair Powell met to discuss the economy and interest rates. During this meeting, Trump advocated for rate cuts, arguing an absence of significant inflation, while Powell reiterated that future policy decisions would remain data-dependent and strictly non-political, upholding the central bank's independence. The U.S. bond market reflects the prevailing mood of investor caution. U.S. Treasury yields have experienced notable fluctuations. These movements are largely driven by persistent investor concerns regarding the trajectory of inflation and the overall strength of economic growth. The 10-year Treasury yield, a key benchmark, is currently hovering around the 3.5% mark. This level is generally interpreted as an indicator of cautious sentiment within the bond market. Investors are carefully weighing the risks, seeking safety, while attempting to navigate the uncertain interest rate environment. The stability of Treasury yields is crucial for broader market confidence and borrowing costs across the economy, influencing everything from mortgages to corporate debt. Furthermore, U.S. tariffs continue to be a significant factor, casting a shadow over both domestic and global economic activity. These tariffs are a major concern for international trade flows and have been highlighted by institutions like the European Central Bank as a potential drag on Eurozone growth. Domestically, surveys are examining how small businesses are coping with the impact of these sweeping U.S. tariffs, which can disrupt supply chains and increase operational costs. Specific companies have also felt the pinch. For example, Lululemon's shares reportedly dropped, and its profit outlook was threatened, partly due to tariff costs. In response, some corporations like Nintendo have reportedly implemented strategies to mitigate the impact of tariffs on their products and upcoming releases. Across the Atlantic, the European Central Bank has taken decisive action. On June 5, 2025, the ECB announced a reduction in its deposit facility rate. The rate was lowered by 0.25 percentage points, bringing it down to 2%. This monetary policy easing was a direct response to encouraging signs of declining inflation within the Eurozone. Current inflation figures stand at 1.9%, moving closer to the ECB's target. The decision to cut rates was reportedly near unanimous among the ECB's governing council members. This move signals a shift in the ECB's stance, reflecting a growing confidence that inflationary pressures are abating in the region, allowing for a more accommodative policy setting. ECB President Christine Lagarde provided further context to this significant policy shift. She emphasized the broad agreement behind the rate cut decision. However, Lagarde also pointed towards potential risks that could still hamper Eurozone growth prospects in the coming months. A primary concern highlighted was the escalation of global trade tensions. Specifically, the impact of U.S. tariffs was cited as a noteworthy factor that could negatively affect the Eurozone's economic recovery and export-oriented industries. In an interesting related development, there are reports suggesting that these very tariffs have sparked increased investor interest in European funds, as capital seeks opportunities shielded from direct U.S. trade policy impacts. European investment banks are also reportedly regaining a home advantage. Meanwhile, the United Kingdom's financial markets have experienced notable movements. The British pound sterling achieved a significant milestone, reaching a 3-year high against the US dollar. This strengthening of the currency has been influenced by a combination of factors. These include mixed economic data releases from the UK, which have painted a somewhat ambiguous picture of the domestic economy's health. Corporate news and developments have also played a crucial role in shaping market sentiment and currency valuations. Adding to this dynamic, reports indicate that UK investors are increasingly adjusting their portfolios, showing a greater allocation towards European markets, while their appetite for US funds appears to have declined recently, possibly reflecting changing risk perceptions. Several specific corporate developments have also made headlines in the UK. Procter & Gamble, the multinational consumer goods corporation, announced job cuts, a move often indicative of restructuring or cost-saving measures. In a development perceived by some as a setback for the London market's prestige as a global financial hub, fintech company Wise made the decision to shift its primary listing to New York. This move highlights the competitive landscape among international stock exchanges. Furthermore, a notable slump in UK sales of new Tesla cars has been reported, with figures showing a decline of more than a third. This downturn has been partly attributed to a consumer backlash against Elon Musk, the company's high-profile CEO. The cryptocurrency market continues to exhibit dynamic and often volatile trends. Bitcoin, the leading digital currency, has recently surged, impressively reclaiming the $92,000 mark. This upward movement reflects renewed investor confidence and buying pressure in the asset. Other major cryptocurrencies such as Ethereum and XRP have also posted significant gains, indicating a broader positive sentiment across the digital asset space. The total market capitalization of all cryptocurrencies has now surpassed the $3 trillion threshold. This substantial figure underscores the growing scale of the crypto market and the strong, sustained investor interest it continues to attract from both retail and institutional participants globally. A particularly noteworthy event in the crypto industry was the stock market debut of Circle Internet Group. Circle is the company behind USD Coin, one of the largest stablecoins. During its initial public offering on the New York Stock Exchange, Circle's stock price experienced a dramatic surge of approximately 168%. The stock ultimately closed its first day of trading at $83.23 per share. This remarkable performance resulted in a company valuation exceeding $18 billion. Circle's successful NYSE debut is a significant milestone, potentially paving the way for other established cryptocurrency firms to seek public listings and gain broader mainstream financial acceptance and investor access. In a strategic move related to digital assets, the U.S. government has taken steps to formalize its approach to cryptocurrencies. President Donald Trump signed an executive order to establish a strategic Bitcoin reserve. This reserve will be funded using forfeited Bitcoins that are currently held by the U.S. Treasury Department from various seizures and legal actions. The stated aim of this initiative is to position the United States as a leader in the rapidly evolving digital asset sector. This development signals a growing recognition at the highest levels of government of Bitcoin's potential strategic importance. It also aligns with broader discussions around Trump's crypto ventures, indicating a potential policy direction favoring digital currency adoption and innovation. Turning to the commodities market, precious metals have shown remarkable strength. Silver prices, for instance, have surged past $35 per ounce. This price level marks a significant 13-year high for the metal. The surge in silver is primarily attributed to robust industrial demand, as silver is a key component in various technologies including solar panels and electronics, coupled with an ongoing supply deficit that has tightened the market. Simultaneously, gold prices have also seen a substantial increase, rising by an impressive 29% year-to-date as of June 6, 2025. This rally in gold is driven by its traditional safe haven appeal amidst economic uncertainty, as well as consistent purchasing activity by central banks around the world seeking to diversify their reserves. The commodities landscape also features ongoing challenges in specific sectors, notably cocoa. Cocoa prices continue to trade at elevated levels, causing concern for chocolate manufacturers and consumers globally. These high prices are a direct consequence of severe supply disruptions originating from West Africa, the world's primary cocoa-growing region. The disruptions are caused by a combination of adverse weather conditions, including droughts and excessive rainfall at critical growing periods, and the spread of crop diseases affecting cocoa trees. These factors led to record-high cocoa prices throughout 2024, and market analysts expect this volatility and pricing pressure to persist well into 2025, creating an unstable environment for the industry. Looking at the broader commodities picture, the World Bank has provided its outlook for the coming year. The institution forecasts an overall decrease in commodity prices by approximately 5% in 2025. This projection suggests a potential easing from the price pressures seen in some sectors recently. More specifically, the World Bank anticipates that energy prices will fall by around 6% during 2025. Agricultural prices are also projected to see a decline, estimated at about 4% for the year. These forecasts reflect expectations of improved global supply conditions for many key commodities, alongside projections for moderate rather than booming growth in global demand, which should help to temper inflationary pressures from the raw material side. Shifting focus to the Middle East, the United Arab Emirates is demonstrating significant activity in emerging financial markets. A considerable number of investors based in the UAE have indicated their intention to increase their cryptocurrency investments throughout 2025. Among these investors, Bitcoin and various stablecoins, such as Tether, remain the preferred digital assets for portfolio allocation. The UAE's appeal as a destination for crypto investments is underpinned by several factors. These include its conducive tax policies, which are often more favorable than those in other jurisdictions, and an increasingly clear regulatory framework that provides a degree of certainty and security for crypto businesses and investors alike. The UAE's influence is also growing substantially in the traditional gold market. Demand for physical gold within the UAE has reportedly increased, reflecting both local investment appetite and the nation's role as a trading hub. The country, and Dubai in particular, plays a pivotal and expanding role in the global gold trade. Dubai has experienced heightened activity in gold transactions, handling a substantial portion of worldwide gold movements from refining to trading and storage. This strategic positioning in both the burgeoning cryptocurrency sector and the established gold market highlights the UAE's ambition to be a key player in diverse areas of global finance, leveraging its strategic location and forward-looking economic policies to attract capital and expertise.